All right, guys, 3 8-pillar stocks, Cisco, Tapestry, and HPQ. Here they are right now. So first off, Cisco. Guys, if you belong to our software, if you're part of our community, please pull up the software right now and go to the 8 Pillars portfolio, 8 Pillars tool, and type in Cisco. If you're not part of our software and like it, everythingmoney.com, eventually check it out, watch our videos, subscribe to the channel. So you'll learn a ton more from here. So Cisco, oh my Lord, look at this. So here's one thing I want to show you at Cisco. Let's go to the max chart on Cisco. Guys, this was Cisco back in 2000. This was the poster child. You can literally Google it and see articles when Cisco hit $500 billion in market cap, people saying Cisco will be the first trillion-dollar company. It never got there. In the next 22 years, the stock never got above its previous high. If I told you here that it was never going to beat that high, you'd have been like, you're crazy. So you might sit there and say, yeah, but the company has sucked. Well, let's see. We're going to go to their income statement. In the year 2000, when their stock was hitting an all-time high, they did $17 billion in revenue. Last year, they did $52 billion in revenue, over triple, and the stock still hasn't hit its all-time high yet. That is the point I'm talking about. So you can overpay for growth. So let's go to the 8 Pillars tab for Cisco. Guys, PE 19, price of free cash flow of 12. So there's a little discrepancy there, but I like it when the free cash flow number is lower. They're buying back shares 17% in the last 5 years. I love it when a company sees undervalue in their stock and buys back their shares. This allows you as the owner to own more of the company by doing nothing. If a company has 10 shares outstanding and you own one, you own 10% of the company. If they buy back 2 shares, you still own 1 share, but now instead of 10 shares outstanding, there are 8. You now own 12.5% of the business. That is the point of buying back shares. Very high return on invested capital, phenomenal level. Revenue growth, profit growth, everything is still growing. So let's go to the stock analyzer tool, the most popular part of our site. So we're going to make our assumptions about the future and see where it tells us to buy. So guys, last 10 years, they've done 0.8% a year in revenue growth. Last year was 5.6. So I'm going to be conservative. Let's call it -1, 1, and 3% revenue growth. I'm going to -1% revenue growth, guys. That's pretty conservative, I would say. Profit margin, 17, 18, 19. Free cash flow margin, 25, 26, 27. PE. Guys, I'm going to go 12, 14, and 16, 12, 14, and 16. When there's not a lot of growth, I want to go with a lower PE. And in this case, there's actually contraction. Remember, a declining business still has value. If I were to tell you, hey, I'm going to give you a business that makes $5 and 4, then 3, then 2, then 1, then goes to 0, it's still worth money. Assuming there's nothing else in the books, still worth money, right? So that's the point I'm trying to make here. There's still value to something, but yes, if it's declining, you want to pay a lower multiple. And then finally, guys, my desired annual return, I'm going to do 12.5%. Now, I usually pick 12.5%, especially for large companies. And the reason being is you can get 9 or 10% just by buying an ETF over long periods of time. So to give yourself some sort of margin of safety and a reason to buy the individual stock, do 12.5%. It's not an egregious amount of return, but it's not low. Hit the analyze button. The stock's at 41 bucks a share. All right, so maybe it's not even worth 41. Our low assumptions are around 20 to 25. Our high assumptions are 30 to 40, 44, and our middle ones are 23 to 34. So here's what I'm gonna do. I'm personally gonna put I'm gonna add this to my watch list at the $34 mark. It's gonna notify me now. So when it hits $33.95, the software will notify me. Remember, guys, this is just math. It's just saying, hey, over long periods of time, if this is where the company goes, you should pay these prices for them based on these assumptions. That's it. It's only math. Only math. Stock number 2, Tapestry. Now, for you guys out there, probably like me, when Tim told me we were going to do Tapestry, I'm like, who the heck's Tapestry? Then he goes, Paul, they own Coach, Kate Spade, Stuart Weitzman. If you don't know what those are, you don't buy your wife enough gifts, or you don't have a wife or significant other. Go buy them one of those. Okay, so that's they make all these big brands for women. By the way, little side note, Kate Spade, right, may she rest in peace, is David Spade's sister-in-law. Did you know that? You didn't know that? Yeah, David Spade's sister-in-law is Kate Spade, and she makes all those purses. David Spade being the comedian. If you don't know who David Spade is, then please just turn off the channel, stop watching us, because David Spade is one of the best comedians of all time. All right, so Tapestry, ticker symbol TPR, 8 pillars. All right, so again, lower price of free cash flow than their PE. I like that more. Shares outstanding, they're buying back about 1.5% a year. Fine. So everything here is a check mark. Let's go look at their income statement. Now, I will say this about the company. This isn't a super, super high-end company. This is a nice brand for not more average income, but so the reason I'm trying to say that is if a recession hits, I imagine this brand will be hit more. Brands like Louis Vuitton, Ferrari, those kind of brands don't get hit as much in recessions. Sometimes actually they don't even see a hit at all because they're so high-end. Their appeal is to people who recessions don't really affect that much. So just be cautious of that going forward. And I'm going to go backwards here to the last recession of 2009. All right, so they didn't actually fall at all. Look at that. Look at their revenue growth. They still grew even during that Great Recession of 2007 to 2010. They still grew, which is great. Now, I don't know if they added brands, etc., but it is nice to see they still grew. So back to the 8 pillars here. So nothing here jumps out at me to go, what the heck's going on here? So let me go to the stock analyzer tool. Now, revenue growth numbers. I'm going to go with 0, 2.5, and 5%. Profit margin. I'm going to go with 8, 9, and 10%. No, 8, 9.5, and 11%. Free cash flow margin, I'm going to do 11, 12, and 13. Nope. I'm going to go with 12, 13, and 14. PE, 12, 14, 16. And look at the current PE, it's 9. So I'm going higher than the current PE and the higher than the current price of free cash flow. But I love that they're so close to each other on the recent basis. So guys, the stock's currently at 31 bucks. Hit the analyze button again with my 12.5% return. All right. So this one's looking pretty good here. High end, 41 to 50. Low end, 18 to 28. Middle numbers, 28 to 38. So I'm going to add this to my watch list at that price, and I'm going to sit there and pay attention to this. Now remember, I still want to be conservative in case there is a slowdown in the recession. I'm not saying to try to time the market. That's not what I'm saying. What I'm saying is just be cautious in your estimates. This is the kind of company, though, that if all of a sudden we hit recession and the revenue starts to fall, you're going to want to pay attention to this company because this could fall very fast, and it might be the company you want to buy into the next economic cycle into positive territory. It could be something that becomes dirt cheap because people are like, oh, people aren't buying their wives and girlfriends these nice purses nowadays. They're going to wait until they feel more on solid footing. All the more reason to. Company number 3, HPQ. Now, guys, HPQ is getting a lot of attention lately. Why? Because our buddy Warren Buffett has taken a stake, 11.5% stake in HPQ. So, oh my God, look at their buybacks. They bought back 37% of their shares in the last 5 years, guys. They bought back over a third of the company, which means you own a third. Is that a third more? No. So before, if there were 10 shares outstanding and you owned one of them, that was 10%. Now there are 6.5% shares outstanding. You now own 15% of the company. It's a 50% increase in your ownership structure. That's incredible. They have revenue growth. They have net income growth. They have cash flow growth. And they're selling for single-digit PE and price of free cash flow. All right, guys, let's go to the stock analyzer tool. Now look at their revenue growth the last 10 years, negative 6.5%. Why? Let's go check their cash flow statement out. Did they sell divisions off? So in the investing section of the cash flow statement, it doesn't look like they might have. This is the acquisitions, dispositions. A negative number means they bought something. Positive number means they sold. Now, granted, they could have sold and bought here, and it just netted out to a minor increase. So who knows? But I would do some more research on why their revenue fell so hard. Because look at revenue over the last 10 years. They did $65 billion last year, but they did $120 billion. Oh yeah, they had to have sold something here. Look at this drop. There's no way. Or they split something off. That's probably what it was. What did they split off? That's what you have to find out. I forget what they split off, but they had to split something off. All right, let's go to stock analyzer tool, guys. Now, revenue growth. I'm just going to ignore the 10-year number on that one. Let's see here. I'm going to go with 0, 2, and 4. Profit margin, I'm going to do 6, 8, and 10. Free cash flow margin, same thing. PE, I'm going to do 10, 13, and 16. 10, 13, and 16. And my return, 12.5%. Again, big company buying back a lot of shares. Guys, the stock's at 31 bucks. It's almost at the lowest number. This is probably why Warren Buffett loves it. Cheap stock, they're buying back shares, selling for a current PE of 5, a 5-year PE of 8 and 6. So if you like these numbers, guys, you got to add this to your watch list. You got to start looking at it now. If you like these numbers, start looking at it now and seeing if this is accurate. Go talk in our community. If you're part of our software, go talk in the community. If you're not part of our software, go sign up. For less than a cup of coffee every day, you can have these conversations on stocks you love. There are 12,000 people who have signed up for our software. They're all talking in here, engaging, and somebody's done the research that you want to do. You can engage in that conversation. If you like this video and you like the 8-pillar process, please watch this video. It's the 8 steps to analyzing a company. It'll make you a better investor. Like and subscribe to the channel. Thanks very much, everyone.